What is diversification? Let's explain it with an example of a car that crashes in a head-on collision, but likely we are not sitting in it. Every car or every new car has active and passive safety features. In the event of a crash, each of these features is important to mitigate damage to my body and increase the likelihood that I will survive the car crash. There's the crumple zone, which is located in the front of the car. Then there's the engine, which cushions the impact with its mass. There's an airbag that stops my body from crashing, and there's also seat belts that stop my body from flying out the windshield on impact. Even though there are more and more cars in the world, accidents are becoming less and less fatal. This means that protective features are being developed in ever better designs and are saving more and more lives. Diversification is something similar. We spread out money across many assets, locations, size, and as each asset behaves slightly differently, it protects us from the fluctuations of other assets. All of these together will give us a more peaceful sleep and a more balanced curve in our portfolio. Welcome to the Invest with Jiri channel. In this video we'll explain the topic of diversification, how to set it up, look at different portfolios, approaches to risk and more. If this is your first time here, please subscribe and ring the bell. If you are as interested in investing as I am, join my community on Patreon. There are discussed portfolio layouts, company analysis or price calculators for value investing. In long-term investing, diversification is essential and reduces the risk an investor is exposed to over time. Diversification may not guarantee us a constant return, but if applied correctly, it will bring a smoother portfolio equity. If only we are all as brilliant as Warren Buffett, we probably wouldn't need diversification and just buy the best assets with the highest returns and get rich very quickly. For us mere mortals, however, this is not the case because we do not live in a fairy tale, but in the real world. Gone are the days when we believe in witches and goblins, and so we have no choice but to think logically and use diversification as a weapon against fluctuations in our assets. Diversification is actually the allocation of money into different assets so that each investment performs in a different market environment or economic cycle. We don't want any of our assets to have overexposure to the whole, and thus any decline in that asset would jeopardize the performance of the entire portfolio. We will show the best diversification with an example. In the picture we see a graph of the evolution of the asset. Now it does not matter if it's a stock, real estate or any other asset. It's just a visualization of price movement over time. Now we add another asset and another and another and so on. And as you can see, the assets balance each other's peaks and troughs. This means that there is a diversification of all these assets into a single entity. The goal is smooth curve of all assets together. See the green thick line. Each asset behaves differently over time, rising or falling, but together they balance out. We just have to make sure that each individual asset has at least some growth in the portfolio, so that it doesn't just keep falling, for example. This is easy to say and mathematically sound, but the reality of the markets is worse. Now let's look at ways to diversify in practice. Diversifying across multiple asset classes, that is between cash, real estate, stocks, bonds, ETFs, commodities or cryptocurrencies. Next, we can diversify geographically. This means that we buy either stocks or any other assets from different locations around the world. Personally, I would do it via computer, but if you have a private jet, you can do it in a person too. Then we can diversify into sector allocations, for example healthcare, finance, technology, energy, consumption sample, telecommunication. Or diversifies between different size companies, for example startups, small size, mid-size, blue chip companies. As you can see, the diversification options are really huge and it's not exactly easy to find the best solution. To make sure we don't get completely lost in the shuffle, let's take a look at sample portfolio recommended to retail consumers at the world's largest banks when the clients are choosing which funds to invest in. The Fidelity page shows a nice breakdown of the portfolios. American stocks, foreign stocks from around the world, bonds, corporate or government, or short-term investments. Here we may include cash, treasury bills, certificates of deposit and other short-term, low-risk investments. The main division of portfolios is into conservative portfolios, where the largest share of investment is in high-quality government bonds. For balanced portfolios, it's roughly half and half stocks and bonds. For growth portfolios, half of the portfolio is purchased stocks, and for aggressive growth portfolios, it's mostly stocks. If you are saying diversification isn't for you because you have an investment of maybe a few $1,000s, you are not far from the truth. Diversification makes sense in even the smallest portfolios and protects your hard-earned money from market fluctuations. We've covered the basic of diversification, so if you like the video, please give it a like and let me know in the comments your diversification story. Have fun and invest wisely!